Many thanks for staying tuned on ADBN Television. This is a market report that we normally bring to you every day, Monday to Friday, 1 to 2 p.m. And here on the market report, we bring you latest information about government economic policy, private sector initiative, and global economic reality as it happens. I already have in the studio seated with me Professor Uche Uwaleke, who will be helping us to dissect the impact of capital market in Nigeria's economy, particularly questions that have been asked. We started a series yesterday with Stephen Wachuku, who helped us to understand what are bonds, treasury paper, as well as commercial paper. Today, we are taking it a step further to understand the intrigues within this capital market and how someone will help us to be able to dissect this in the person of Professor Uche Uwaleke. Prof, very good day to you and welcome, sir.
Thank you, Leko.
All right, sir.
For having me.
Thank you, sir. So, Prof, let's start. I won't even ambush you with any question. Just give us a background, because I discovered that a background history of Nigerian capital market will go back to 1970. So just give us, so that our viewers can understand how this journey has been for Nigerian capital market.
Thanks so much, Leko. Well, when you talk about the history of the Nigerian capital market, it dates back to beyond 1970. As a matter of fact, even before the independence, in the colonial times, when the British government at the time issued a development stock. Okay, when you talk about the capital market, really, what comes to mind is long-term funds. But we started having it formally. We started formalizing the capital market in Nigeria in 1960, 61, when the Lagos Stock Exchange was established. It took off in 1961. An exchange is nothing but a platform that enables the trading in shares. So that platform, as I said, formally took off in 1961. So you can say to a large extent that the capital market didn't really start in its formal form until 1961. Then, of course, we had a few companies that were listed at the time. In 1977, the Lagos Stock Exchange, got renamed as the Nigerian Stock Exchange. So it was in 1977 that they changed the name to Nigerian Stock Exchange. Then on and on and on, of course, we had developments, over the years, including the major one that happened in the 80s, when the index, was, if you like, put in place. And then from that point on, I would say the market has witnessed a number of, remarkable improvements, over the years. So today we don't just talk about Nigerian Stock Exchange, which of course has also become now the Nigerian Exchange. Exactly. When following demutualization, when they opened up and through their shares open to the public and also got listed, it now became Nigerian Exchange. Nigerian Exchange is demutualized. So the point I'm making is that today it's not just one platform. We also have other platforms. So we have, I'm sure you've heard about the financial market dealers quotation, the FMDQ. In the FMDQ too, bonds are traded. Exactly. Bonds are capital market instruments. In fact, that's where the bulk of the bonds are traded. And on the secondary market, that's the FMDQ. Then you also have the National Association of Securities Dealers. We call it the NAST. The NAST PLC is where you have unlisted securities where they are traded. So we also have even commodity exchanges. Today we have the Nigerian Commodity Exchange, the one you have in Abuja here. Exactly. Then you have the Lagos Commodity and Futures Exchange, and you have the FX. So in terms of market infrastructure, I would say a lot of improvement, has happened. That infrastructure has been modernized, such that today again, if you decide to buy shares or you're selling shares, the transaction cycle, has been reduced to what it used to be. T+5 to now T+3. Okay. I also remember when I qualified as a broker, I think in 2007 or so, the way trading is done now is a lot different from what back in the days. Today you can even sit in your office and trade. So a lot of improvements have taken place in the market. As far as the capital market is concerned, in West Africa, Nigeria is number one. Okay. because November last year, I had the privilege of visiting a number of countries in West Africa, Gambia, Guinea, Liberia, Sierra Leone, under the UN Development, United Nations Commission for Africa. Was sponsored, and part of what I went to do there was to see how I was part of, if you like, resource persons, taking there to see how we can also help those countries, also develop their capital, because they don't have formalized capital markets. So Nigeria is way ahead of them. But of course, if you look at the entire Africa, Nigeria is behind South Africa. South Africa is by far ahead.
Exactly ahead of it. I know Egypt is also competing, strongly with the two leading countries, Nigeria and South Africa.
Yeah, Egypt's exchange is even older than that of South Africa. It dates back. Egypt is
quite a well-civilized country.
Yes, quite old. So if you talk about Africa, really, the major ones you talk about, Egypt, Kenya, Morocco, Nigeria, South Africa. These are the leading exchanges you have in Africa.
Very good. I know when we start the segment of African stock review,
yes,
I'll still bring you on that aspect. Now, looking at the opportunities that are vast in this sector of the economy, because most Nigerians are yet to understand the opportunity. So how would they be able to appreciate this opportunity and be part of it?
Yeah, the market has a whole lot of opportunities. Of course, for not just for investors, those who are willing to invest, but also for even those who are seeking funds, who are who plan to borrow, who wish to borrow. Of course, the major function of the market, just like any other market, financial market, is intermediation. What are you doing? You are trying to mobilize funds from those that have the surplus units. You now channel to those that need of those funds, the deficit units. Okay. Now, in the financial markets, of course, we have the money market, the money side, the side that deals with short-term funds. I heard you saying someone came here to talk about commercial paper,
exactly.
Treasury bills. Now, commercial paper and treasury bills are not capital market, products. They are more of money market because they are short-term.
Exactly.
Okay, but when you talk about capital markets, essentially the traditional ones are your shares and then your bonds. These are the traditional ones. And then those who are seeking to borrow long-term, medium to long-term, of course, can use bonds to borrow. Companies can issue bonds. Governments also issue bonds. In fact, as I'm talking to you, as we are talking now, I'm sure you must have read that the FG, the federal government, is currently issuing, of course, the DMO does that on behalf of the years. It's currently issuing FGN savings bond. Okay. With just as little as 5,000 naira, you can invest in the FGN savings. It's on now. You can invest in the FGN savings bond. You'll get your returns every 3 months. Okay. And of course, you don't pay tax on them, on the returns that you have. So there are a lot of opportunities, in that market. For investors, it offers a lot of investment opportunities. Investor can invest in shares. You can invest in bonds. You can also invest in other products that are available now, such as exchange-traded funds. Those ones are more or less advanced products. Okay, but essentially you can do shares, you can do bonds. And my advice to the people out there who wish to invest in shares, particularly low and middle income earners, is not to invest directly in the market. You invest through collective investment schemes. We call them mutual funds. Okay, so you have mutual funds that what they do is they pool funds from a lot of people and then they invest. Okay, so whatever money that comes from it, returns are now shared, among the unit holders. So that's the best way for somebody with 100, 200, 500, 1 million naira to invest in the market. Because if you have $1 million, for example, and say you want to go and buy shares, you want to go and buy, say, Seplat, you can't afford many units of Seplat because Seplat is very expensive. Each unit of Seplat, for example, is 5,700. Today, you want to buy Airtel, Airtel is also expensive, over 2,000. So the best way you can invest in these stocks, if you're interested in them, is to go through a mutual fund route. So that is my advice to investors. So you go to the SEC website, for example. By the way, the capital market is regulated by the Securities and Exchange Commission. So any information you need, you can always access the website of the Securities and Exchange Commission. So if you go there, you check the licensed stockbrokers, for example. You check the licensed mutual funds, so that you can deal with those ones because they are genuine, they are licensed. And that is why it's very important that investors don't do without doing due diligence checking, okay, and they don't fall into wrong hands, end up investing in Ponzi schemes.
Exactly. Yeah, because the SEC has even warned a lot of Nigerians to engage in that.
Exactly, because of it's risky, and you're also dealing with people that you can't trust. They are not licensed. Tomorrow they can vanish with your funds.
True. Okay,
so what I've just described now is on the part of the investor. Now, the opportunities to exist even for companies. A number of companies. One of the things that the capital market does, especially the platforms I talked about, okay, the platforms will enable companies to raise funds. So when you now raise medium to long-term funds, you can use them to expand. You can now use them to, of course, when you expand, job opportunities are being created.
Exactly.
Okay, the economy is better for it. That's what we actually call capital formation. All right. So companies come there to raise funds. And how do they raise these funds? Through basically two means. They can issue shares, okay, or they can issue bonds. When they issue shares, anybody that buys those shares become anybody that buys the shares qualifies as a member of that company, as a shareholder. So when the company makes profit, the returns are shared. Okay, but if it's a case of bonds, bonds are not bondholders. When you invest in a bond, when you buy a company's bond, you're not a shareholder. You're only entitled to interest because you are seen to have lent money to that company. So these are the two instruments, and investors should know the difference between a bond and a share. Yes, in which a bond is less risky than a share. So if you are the type that you don't like risk, go and do bond. Yes, but if you are the type that also you like risk and you like high return, you can do share. Because generally in the market, the higher the risk, the higher the return. The higher the return, the higher the risk. Okay, so because why I'm saying shares are risky is the fact that a company can make profit and decide not to.
I'm even coming to that.
Pay dividends.
I'm coming to a question that will help us understand that aspect, because when you check some of the report of companies, you see them with bogus out in terms of their profit after tax. But giving shareholders their money become a challenge. And this brings me to the question of what does inflation have to do with it?
Okay, yeah, look, before I talk about that, it's also important I mention the other leg. I talk about companies, benefits. You see, a good example is what we have now. The central bank has said banks should recapitalize, right?
Well. Yes.
If you have international license, you must have 500 billion. Where are the banks getting the money now? So now many of them are going to the market to get the money. Exactly. So they are issuing shares and are getting the money. And today we hear Access Bank has met that requirement, that threshold. Okay, and the other banks are also there. So that is one of the benefits the market offers. Yes. So it enables companies to quickly raise funds. All right. Now the government. So if you look at the government, so it's also helping the government. Today, here the government is running deficits.
True.
Budget deficit. Over the years, what is budget deficit? What you plan to spend is higher than what you are getting. That difference, where do you get the money? Most of the time, the government runs to the capital market to borrow. That's why you hear government is always issuing FGM bond. FGM bond, right? Those bonds are instruments by which the government borrows. So if you invest in government FGM bond, you have lent money to the government. So the government is also benefiting. The market is there to help the government also finance its deficits, meet its obligations. So you can see how relevant the market is to the economy. And why I'm saying this is, you see, what the market does, okay, these examples I've given now, is not something you can get from the short end of the market. The short end of the financial market is called the money market. I mentioned it.
Yes.
So for a country to develop, that economy needs long-term funds, not one-year funds. You need medium to long-term, because that's when you get it. That's what you can invest. That's what you can use to do roads, to do projects, right? So to that extent, the capital market is of immense benefit, not only to companies or individuals, but also to the government. So economic agents. Okay, now to your question, yes, you see, a company can make profit and decide not to pay dividend. The directors, shareholders, of course, agree that, especially the directors would decide not to pay, a dividend, and that's sometimes it's because of a situation where a company is having liquidity challenges. A company is having some liquidity, so the profit has been made. It's not really cash backed, so you can't afford to pay dividend. All right. Another reason is also when a company has identified an investment opportunity. Okay, today you hear Access Bank is expanding in some other African countries. UBA is also expanding. So these companies, for example, when they identify those investment opportunities, even when they have made profit, they may not want to share them out. Okay, they may want to use those monies for further investment. So what usually happens is when they do that for further investment, it's expected that it will ultimately be in the interest of the shareholders. Okay, so it's for them now to explain to them, please hold on, we're expecting something bigger. Okay, we want to use that money to get something bigger for you. All right, so that's one reason. Another reason, of course, the major one is when a company doesn't make it, no profit. If you don't make profit, you can't pay. You can't pay dividends. So, and that's why when you are investing, you have to, one of the things you should check, okay, particularly if you are the type that is interested in dividends, you check the track record of that company in terms of dividend payments. If I want to invest in a company now, okay, I want to see the company's last 5-year financials, results, last 5 years. I also want to know whether over the last 5 years they have consistently paid dividend. If they have not, and I am the type that is interested in dividend payment, I wouldn't invest. But once a company has a track record, every year it must give dividend, okay, then I can invest. And that's because when I want to calculate my return is not just the dividend I'm getting. My return is not just the share appreciation I'm getting, but also the dividend that is coming, okay? And that is why I'm conscious of the fact of, trying to ensure that the company I'm investing in must have that track record, okay? Now, again to the question you asked, you see, the performance of the capital market and the markets in general, whether capital or money market, okay, is a function of the well-being of the economy, of the performance of the economy. So if the macroeconomy is doing well, okay, you should expect that the market too is likely to do well. And that's why when you have an economy where you have, for example, you mentioned it, high inflation rates, okay, high interest rates, high exchange rates, these prices, okay, when they are, if you like, dislocated, don't augur well, don't rub off well on the markets. So if you're on investment decisions generally, so if you have high inflation, if you want to invest, for example, you want to invest in the market, you want to buy, you're looking at the return. If the return you're going to get is 10% per annum, and inflation is running at 20, the money is eroded now. So, but the good news is that our market over a long period of time, okay, research has shown that the capital market over a period of time, has beaten inflation. Okay, usually stays ahead of inflation. Look at last year, for example. Last year, the market, on the average, returned 37%. The return on the market last year was 37%. Inflation rate end of last year 34%. So return higher than inflation. But if you look at most asset classes, their returns were below inflation, but that of the capital market higher than inflation. Okay, so it's only when you have a return, you are investing, you're asking yourself, what's the inflation rate, what's the expected return, okay, expected inflation rate. If the return is higher than inflation, that's when you can have confidence to invest. So to that extent, inflation affects investment decisions. So high inflation rate is not good for, and that's why the central bank is also, after bringing down inflation because of its impact on investment. Yes, the same thing also applies to interest rates. Okay, although it works
both sides.
Yeah, both sides.
Somebody says a double-edged sword.
A double-edged sword, yes. Because if interest rate is high, for example, what do you find? You find people tending to now invest in bonds. Fixed income securities, because I told you when you invest in bond, what you get is interest. Exactly. So as interest rate is going up, you see people also investing in fixed income, investing in treasury bills. Okay, so the money they would have used to buy shares, they're using it to buy treasury bills, all right. Exactly. So one side of the market is also benefiting. But for the equities, the shares are called equities. For the equities market, high interest rates, tend to be inimical to the growth of the equities market.
Someone told me, say, it discourages people from coming there the moment they see that interest rate is jacked. But I have a question, maybe before we end this program, about this next CBN MPC meeting. But I'll give that question to the bottom of our discussion. Right. Now, another aspect of the things that many people ask about the exchange rate of Naira to dollar, I discovered that just last year into this year, foreign FPI are interested in Nigerian stock market. Foreign portfolio investment. What drive that? Even though people are saying Naira is dragging, Naira is falling, but we are seeing a rebound of the Naira some few days now. But in the past, what is driving foreign portfolio investor into Nigerian stock market?
Another double-edged. See, one man's needs another man's poison. Yeah, so what's happening is inflation rate is going up, right? What central bank responds to high inflation rate, central bank is increasing monetary policy rates. Is that not correct?
Very correct.
Yes, to be able to reduce money supply and reduce inflation.
Exactly.
So that's the central bank approach to reducing inflation. So interest rate is going up. Now, if interest rate is going up, it means the returns, remember, is also going up. Right?
Yes.
So the foreign investor out there is interested in high return. So when interest rates are going up, that's when you find them coming to the market to invest, right? Again, when the Naira is depreciating, remember when there was unification of exchange rates, what happened? Naira was devalued, okay? So when you have weak Naira, the dollar is strong. So the person who has dollar, who is holding dollar in the US or in the UK, okay, the dollar is strong, okay? That person can bring very little dollar to now invest in Nigeria. So to them, depreciation of the Naira favors a foreign investor. Okay, at least at the point of bringing in the money. Okay, okay. What they bother about is if it's highly volatile. They're not sure of what's the rate exactly. But at the point of bringing it in the money, it favors them. A high interest rate, it also favors them. They bring in. Okay, so that's why you find that FPIs, as already mentioned, foreign portfolio investment. Okay, they tend to come in when you have high interest rates. Okay, but you also notice that if you look at the report by the National Bureau of Statistics on capital importation,
yes.
Foreign portfolio investment, has always been the highest. Foreign direct investment has been very low. So we have not witnessed, massive foreign direct investment as we ought to, and that's also something that's tied to inflation, because the foreign direct investor. Remember, he's bringing in patient capital.
Exactly.
Okay. Foreign portfolio investor is bringing in hot money. He invests. Once there is a shock to the economy, he runs. So that's portfolio, and portfolio is dangerous to the economy to that extent.
Exactly.
But foreign direct investment is what the economy requires, because that's patient capital. It's an investment that is coming to stay, an investment that is coming to create jobs, for example. Okay, and that investment can only come when there is a stable macroeconomic environment, okay, when you also have, when in terms of infrastructure, okay, the investor can come and say, for example, that power, stable light, and all of that. So these are, if you like, conducive business environments. So when we talk about ease of doing business, actually, we are speaking to these things, because they are the things that actually attract foreign direct investment, which is, as I said, what it is. Foreign portfolio is simply temporary.
Exactly.
Okay, and what are they seeking? They're seeking alpha. Let me use the technical term, alpha. They're seeking returns. They're just here for returns.
Exactly.
Okay, and that's why I don't think it's something. Even though yes, it's something we need temporarily to, but it's not something we should celebrate. Yes, because
I see the president and his government are quite interested in FPI. I've seen the CBN governor, appreciating how much of the volume of this FPI, particularly in our foreign reserve. The thing is jacking up over 40.88 billion US dollar, but recently it has dropped to 40.66, according to what the CBN said.
Yeah, because it has a temporary, it has a shooting. It's like a shooting bomb. Yes, temporary effect. Yes, that's why I understand the central bank governor too, and saying yes, we also need it, because even if it's for 2 months or 3 months, at least it will help to stabilize the market. Okay. So that's what I'm saying. It's a shooting bomb. So it enables the central bank to buy time. To buy time, and that's why most of the time you hear central bank talk about sequencing.
Exactly.
Buying time means, okay, let's have this temporary, and then in the meantime, let's work towards the sustainable. Yes. So it only gives them like it's a breather, a breathing space. So it will be worse if it didn't come at all. If it didn't come at all. Yeah.
So let's also look at another aspect of the capital market that I know many viewers, many Nigerians have been asking questions. Now, we have talked about aspects whereby, people can go in, the opportunities are available, but the aspect of small businesses also participating, it has been regarded as so limited. Why? Although I have someone who told me that one of the problems is because, as rightly pointed out, the funding there that is most of those companies release could be hijacked by the big corporation, by the big people, unless they follow the route you mentioned, the mutual
funds. Mutual funds is from the point of view of the investors. Okay. Now you are talking about issuers.
Exactly.
Okay. Issuers are those who go to look for money. Okay. So a small company, so of course, goes there to look for money. So the reality is that you see, for you to go to the market to list. Okay, you want to list on, for example, on the exchange. There are requirements.
Exactly.
Okay, and small companies are usually not in the position to meet those requirements, and that's why over the years to send the exchange, the members in particular has also tried to reduce those requirements in order to allow small companies to come and list. Recently, they have also established other sub-platforms, like the Growth Board, okay, to also encourage startup companies to come there, list and be able to raise funds. I'm also aware, even the other platform I talked about, the NAST. NAST also accommodates, smaller companies. But the real small companies, okay, may not be able to, as I said, get listed, okay, and then begin to raise funds again because of the requirements. So, and that's why it's important that, and that's also why I like what is happening now in terms of the tax reforms. Okay, what the tax reforms, what they're seeking to do is to also enable small businesses to grow to a point where they can then begin to look for, large capital to expand. Yes. So you allow them breed. And how do you allow them breed small businesses? By even exempting them completely from tax, which is what the tax reforms, yes, that's what one of the things it seeks to do. Businesses, if you're a business and your turnover is not less than 50 million now, yes, you're not paying tax at all. So that's why I'm saying, it used to be 25. Yes, it's currently 25. Yeah. Once this one goes through, it will not be 50. So you're allowing small businesses to breed, they won't pay that. So by the time they get to a certain level, the next thing they'll be thinking is how do they expand? And of course the option becomes the capital market. You see, and that's why you find in Nigeria today, I'm sure if you go to the CSC, you'll see over 4-5 million companies that are registered, right? But on the on the exchange, maybe use the members, you have 151 companies that are listed out of several that could have been listed, all right? And that's why we are saying that the government can also use some incentives to encourage more companies to come and list. We have a lot of companies out there that don't bother about coming to list. Yes, in South Africa, the total number of companies listed 274. Nigeria 151. I told you South Africa is far ahead of Nigeria when it comes to the capital market. So we need a lot of companies to list, and one way the government can do that is to again use incentives, tax incentives. Okay, for example, I read recently Jamaica. Jamaica. One of the things they did in Jamaica was to use exemption, tax exemptions for companies that get listed. So if you get listed, for example, for the first few years, you don't pay tax. So that's they saw that as an incentive. So from 35 companies that were listed on Jamaican stock exchange, the number jumped to 100. This is a small country. I don't think the population is up to 3 million. All right. So, and Nigeria, here we are, over 200 million. We are big. So, if the government uses that kind of incentive, if you list for the first 1 year, you won't pay tax. I'm not saying 3 for it because that government will lose money. Yes. But for the first year, you see, what the government may end up appear to be losing in that first year, they will end up recovering it later. Do you know why? If you look, FIRS will tell you that the bulk of the company's income tax that they get is from listed companies. Do you know the companies that pay the highest tax in Nigeria? MTNs of this world now. Dangote Cement. These are companies that are listed on the exchange. Because when you list on the exchange, what happens? You are exposing your books. Your books must be made public, must be open. So the what do you call it now? The opportunity. Is the opportunity to evade tax
will not be there.
Will be reduced. Because as I said, your books are open. And that's why it's important for more companies to come and list. All right, and as I said earlier on, the government can encourage that by using tax incentives. All right, and also even by also leading by example. What do I mean? By saying, for example, NNPC.
Actually, they have promised to be there.
They have been talking about it now. They've been talking about. So this is the time to say, NNPC. Let's put part of just a little part of your 5-10% of NNPC. Let's list on the exchange. That's what Saudi Arabia did. Okay, I'm sure of course the government is aware. I'm sure it's something that is in the works. But what I'm saying, advocating is, we should expedite action
on them
on this listing, because the moment you list NNPC, NNPC becomes more transparent. Governance issues in NNPC will highly be enhanced.
Exactly.
Okay, this issue of is opaque. We are not understanding.
We are not understanding. Exactly. That account will just come from nowhere. Everybody will just.
Those things will be 10 of the past.
Prof, we don't have much time, but this particular question is tempting. We have Prof is laughing. We have less than 10 days to the next MPR meeting. The question will be sent to you very soon about it. Yes. Both you, Bismarck Iwani, and most of our other economists.
I've been entertaining questions.
Exactly. Yeah. Less than 13 days from now, February 17 is sacrosanct for the next MPCR meeting.
Yeah.
What is our projection? Some people are saying we are going Dove again. Some people are saying no, we are going Okish. Which side are you? Okish or Dove?
Okay, I am in between. Say, like, you can bet on it. The MPC meeting, next meeting, members are going to hold the rates. They're not going to increase. Yes. Do you know why? That is because any moment now, the National Bureau of Statistics will release the rebased GDP and rebased CPI. So once they knew, that's even why the MPC meeting was shifted.
Yes.
Okay, because MPC they want to see the figures, and then they want to work exactly. So the expectation is that the new GDP figure will be higher. The expectation is that the new inflation rate will be lower. That's the and the moment inflation rate new figure is lower, MPC members, can have justification not to increase. And with time, I predict too that even before maybe second quarter or third quarter, before the end of the year, I expect that the MPC will begin to reduce. Yes, and then move from hawkish to dovish
side of
but they're not going to be hawkish. Yes, hawkish would mean they will increase. I don't see them increasing rates.
Although we have learned from past CBN government.
So the interest of the environment in 2025, if I look at my
projection,
my the prism, my crystal ball, I think it's going to be low interest environment for 2025.
Exactly. Or at least for 2025 it's going to be low, based on what both CBN, BC, and the government is doing or to. Prof, I can't thank you enough. Engaging you sometimes in class is quite enlightening, very interacting, on air too. I remember some few years back when we had our radio show. That is how, I think we should just continue.
We are limited
by time down.
Yes,
And I hope my producer will create indulgence to and let us have another continuing discussion around this area and other related economic issues.